If you've been watching the silver market recently, you've probably felt something strange. The price hasn't collapsed. It hasn't broken out. It's just sitting there. Silver has been trading in a tight range, roughly $60 to $63, week after week. To most people, that looks like nothing is happening. But in markets, the most important moves rarely announce themselves with fireworks. They happen quietly, and right now, silver is sending one of the most important signals it can send: flat price. Massive volume. That combination almost always means one thing: someone very large is buying everything that's being sold. Today, we're going to break down why the data strongly suggests that a single powerful buyer has quietly accumulated hundreds of millions of dollars worth of silver, who that buyer most likely is, and why this moment matters far more than the daily price chart. Part 1. Why boring? Price action is often the most dangerous. Let's start by addressing the biggest misconception. Most people think market action only matters when prices are moving fast. Up feels exciting, down feels scary, flat feels irrelevant. That's wrong. In fact, flat price action during periods of heavy volume is often where the most important positioning occurs. Here's why. In a normal market, rising prices, past rising volume, demand, overwhelming supply, falling prices, subsist, rising volume, supply, overwhelming demand, flat prices, plus low volume, disinterest. But when prices remain flat while volume surges, it means supply and demand are colliding, and someone is deliberately preventing price movement. That doesn't happen accidentally. It happens when a buyer is large enough, patient enough, and motivated enough to absorb relentless selling without letting price rise. And that is exactly what silver is showing us right now. Part 2. The footprint of a large hidden buyer. Let's talk about scale. Recent volume data suggests that 10 to 15 million ounces of silver have changed hands over a short period of time, without any meaningful price appreciation. At current prices, that represents $650 million to over $1 billion in value. That immediately eliminates several potential buyers. This is not retail money. Retail doesn't move that consistently, globally or quietly. This is not a hedge fund trade. Hedge funds chase momentum. They don't suppress it. This is not bullion banks positioning for a short-term trade. Banks intermediate liquidity. They don't warehouse massive physical exposure without a reason. This is strategic accumulation, and the way it's happening tells us even more. Part 3. Iceberg orders. How whales buy without moving price. What we're seeing in silver fits the classic definition of an iceberg order. An iceberg order is used when an institution wants to acquire a massive position without alerting the market or driving prices higher. Only a small portion of the order is visible at any given time. Behind the scenes, much larger hidden orders continuously absorb supply. To everyone else, it looks like price can't break out. In reality, the market is being quietly drained. Think of it like pouring water into a sponge. From the outside, nothing changes until the sponge is full. And when that happens, price doesn't creep higher. It jumps. Part 4. Physical signals, where paper and reality diverge. Another critical clue comes from the physical silver market. Even as paper prices remain flat, physical premiums are rising. Delivery demand is increasing. Fewer participants are rolling contracts forward. That tells us something important. This buyer doesn't want exposure to silver. They want silver itself. That distinction matters. Paper silver is easy to trade. Physical silver is difficult to source at scale, which means whoever is buying has a reason that goes beyond speculation. They need the metal. Part 5. Who is not the buyer? Before identifying the likely buyer, let's eliminate the obvious candidates. This is almost certainly not retail investors, momentum traders, hedge funds, central banks, bullion banks. Retail investors don't buy like this. Hedge funds don't suppress price while accumulating. Bullion banks don't stockpile physical silver for long-term use. This buying is continuous, algorithmic, global, present across all time zones. The footprint points to one category of buyer, a strategic corporate entity. Part 6. The big tech connection. Now we get to the heart of the thesis. The strongest evidence suggests this buyer is big tech, specifically AI hyperscalers, such as Microsoft, Google, Amazon, Meta. And the reason is simple: energy. Artificial intelligence is not software, it's infrastructure. An AI infrastructure consumes staggering amounts of electricity. An AI-powered query uses 10 to 30 times more energy than a traditional internet search. As AI adoption accelerates, power demand is exploding. And here's the problem: the grid cannot support it. Part 7. The AI energy crisis. Nobody is talking about. This isn't a future issue. It's happening right now. Data centers are already competing with cities for electricity. Power utilities are overwhelmed. Permitting new generation takes years. Big tech understands this, and because they've publicly committed to net zero targets, they can't just burn more fossil fuels. So what's the solution? Build your own power. At scale, fast, and clean. Part 8. Solar, storage, and silver. That's where silver comes in. Silver is critical for high-efficiency solar panels, power transmission energy storage systems, AI data center infrastructure, and big tech is investing accordingly. One example alone tells you everything you need to know. The $30 billion AI infrastructure fund launched by BlackRock and Microsoft. That single fund exceeds the entire annual dollar value of global silver mine supply. If you're building power systems at that scale, you don't wait for silver prices to explode. You secure supply in advance, quietly, strategically, aggressively. Part 9. The Jevons paradox. Why efficiency increases demand. A common argument against silver demand is efficiency. If solar panels use less silver per unit, demand will fall. History proves the opposite. This is called the Jevons paradox. As technology becomes more efficient, it becomes cheaper, and adoption accelerates. More efficiency leads to more solar installations, larger energy systems, overbuilt capacity, more storage requirements. And AI data centers require constant baseload power, not intermittent generation, which means overcapacity solar massive battery banks, redundant systems, all of which are silver intensive. Efficiency doesn't reduce silver demand, it multiplies it. Part 10. Crowding out who loses access to silver. As big tech absorbs supply, other sectors face a problem. Some industries cannot reduce silver usage. Medicine, where silver is essential for antimicrobial applications. Defense, where silver is used in guidance systems, electronics, and batteries. These sectors are price inelastic. They don't substitute. They bid. The only flexible demand comes from jewelry and silverware, especially in India. As prices rise, scrap supply comes to market. But scrap is finite, slow, reactive. That creates a dangerous imbalance, immediate industrial demand. Delayed supply response, which is how markets overshoot violently. Part 11. Market structure. The final accumulation phase. From a market structure perspective, everything we are seeing in silver right now points to what technicians and institutional traders refer to as the final accumulation phase. This phase is never exciting. In fact, it is usually the most frustrating part of any major market cycle. Price stops trending. Volatility compresses, breakouts fail, rallies stall. To most participants, it feels like the story is over. This is by design. Accumulation phases exist for one reason: to transfer ownership from weak hands to strong hands. Weak hands are driven by emotion. They need constant movement, validation, and excitement. When price goes sideways for weeks or months, boredom sets in. Doubt creeps in. Positions get sold, not because the thesis is broken, but because nothing is happening. Strong hands operate differently. They don't care about short-term price action. They care about supply. They care about future necessity. They care about control. So while sentiment fades and attention moves elsewhere, strong hands quietly continue to buy. Every dip, every sell order, every moment of impatience. This is why the final accumulation phase is always uncomfortable. Price goes nowhere. Bullish narratives sound tired. Bearish narratives sound convincing again. And that's when the transfer accelerates. But here's the most important part, and the part most people miss. Accumulation is not about pushing price higher. It's about removing supply. Well, once enough supply is removed from the market, something critical changes. The price floor disappears, not because buyers leave, but because sellers are gone. And when that happens, the market doesn't ease into the next phase. It transitions abruptly. This is when markets move from accumulation into what S called the markup phase, the phase where price finally reflects what has already happened beneath the surface. Part 12. The price, vacuum, above 65 baht. This brings us to one of the most important technical and structural observations in the silver market right now. Historical volume profiles show something extremely telling. Above $65, silver enters what traders call a price vacuum. A price vacuum is a zone where very little historical trading has taken place. That means there is very little overhead supply. Very few holders waiting to get back to even and sell. Markets move slowly where supply is dense. They move fast where supply is thin. And above $65, supply is thin. That doesn't mean silver instantly shoots to $85 or $100 the moment it breaks 65. Markets don't move in straight lines. What it does mean is that once price enters that zone, resistance weakens dramatically. Pullbacks become shallow. Rallies extend further than expected. Momentum builds faster than models predict. Why? Because there's simply nobody left to sell in size. During accumulation, sellers are exhausted. During markup, buyers compete. That's a completely different environment. And this is why long periods of flat price action often precede the most violent moves. Not because something suddenly changed, but because the change already happened quietly. Conclusion: don't fight the whale, draft behind it. This leads to the most important takeaway of this entire analysis. Don't fight the whale. And just as importantly, don't chase it either. When a participant this large enters a market, retail investors cannot outtrade them, outguess them, or front-run them, but they can position intelligently. The correct approach is to draft behind the whale. That means respecting periods of flat price action, understanding that boredom often signals accumulation, avoiding emotional selling just because nothing is happening, letting time work instead of forcing outcomes. A flat price does not mean stagnation. In many cases, it means the exact opposite. It means the market is being prepared. Silver is no longer just a speculative metal driven by sentiment cycles. It is increasingly a strategic industrial resource tied to energy, technology, and infrastructure. And when assets make that transition, price discovery changes permanently. These moments are never loud. They are never obvious. They're always doubted until they're over. And once they're over, price doesn't wait for consensus. It doesn't wait for headlines. It doesn't wait for permission. It just moves. Thanks for watching. If you found value in this deep dive, make sure to like the video, subscribe to the channel, and share your thoughts in the comments below.